Excited to have this conversation, and I think we're going to have a lot of good back and forth and Q&A. I think we're going to dive right in here. We've got quite a few folks on the line right now. I'm just going to start off and hand things over to Andy, who's going to be moderating the conversation. For those that don't know, Andy Sinclair is a CEO and a principal at Midlock Investment Partners, which is a boutique investment firm that focuses on investing in real estate deals valued between about $5 and $50 million. And Andy's been doing this for quite some time and has been involved with about $2 billion in transactions over the years, but really his core focus has really been sort of deal sourcing on value add deals specifically. So with that, Andy, I'm going to hand it over to you.
Thank you, Rafi, and thank you for everyone who's joining us this afternoon. We welcome you to our presentation. My name is Andy Sinclair. I'm the CEO of Midlock. I will serve as the moderator for today's panel. In just a minute, we're going to introduce you to the expert panelists that you see in front of you. Before we begin, though, I want to address the ongoing COVID-19 situation gripping not only our nation, but also the globe. We want to express our gratitude and appreciation for all the work that's being done behind the scenes, especially by our first responders and our healthcare workers. For that, we appreciate all that work is being done. With that, let's introduce today's topic, a commercial real estate roundtable discussing the state of the market. I'm joined today by several expert panelists, and you'll see their resumes and bios on the screen. I'll introduce each one in particular. First and foremost, I'm joined by Kevin Smith. Kevin is the retired managing director and head of the Americas for PGIM, the commercial real estate arm of Prudential, one of the largest global investment managers in the world. Currently, Kevin is an adjunct instructor of real estate at Marquette University, and he is the vice chair of the board of trustees of Wilmette University, his alma mater. Kevin also holds a master's degree in city planning from Harvard University. Kevin also added another role to his already impressive resume that he alerted the panelists on our prep call. He recently became a grandfather, so congratulations, Kevin, and welcome to today's program.
Thank you.
Additionally, we're joined by Adam Hooper. Adam is the CEO of RealCrowd. Adam founded RealCrowd in 2013, and since that time has brought its members access to over 6.5 billion of real estate investment opportunities. Outside of his core role at RealCrowd, Adam hosts the podcast, which is an educational podcast for real estate investors around the country. Here at Midlock, we already subscribe to Adam's excellent podcast. Adam, thanks for joining today.
Glad to be here.
Our third panelist is Josh Kurznak. Josh is the president and CEO of a Minneapolis-based commercial real estate firm, Hempel Companies. Josh possesses an extensive commercial portfolio, having developed and owned over 750 million and more than 2.5 million square feet since 2002. Josh currently sits on the executive committees for the Muscular Dystrophy Association and AVIVO. Josh is also on investment committee and served as a principal at Midlock Investment Partners. Josh, thanks for joining today.
Thanks for having me.
Before we begin, we'd like to outline the topics for discussion today. We plan to cover four main topics. One, the current crisis and how it compares to other previous recessions. Two, property and operations and what changes we can expect to see. Three, real estate risk and underwriting. Four, where is the investment opportunities today and what strategies might prove effective? We'd also like to call the audience attention to the Q&A function on Zoom. We will be fielding Q&A after we cover these four topics, and the panelists will be open to questions. If you prefer to email your questions, you may email Midlock Senior Associate Tim Donovan, and his email is tim, T-I-M, @midlock.com, and Tim will relay those questions to us. With that, let's get started with the panel. The first topic is the current crisis. Prior to COVID-19, the question persisted of when the next recession would occur. I think it's safe to assume it's here. With that, now the question switches to how does this current crisis compare to other previous recessions, such as the Great Recession from 2008 to 2010, or perhaps the tech bubble or the Great Depression? Adam, your members and investors must ask this question daily, I'm sure. Many of them are willing to take your advice. What are some thoughts you can share with the crowd?
Yeah, well, first, again, thanks for having me here. Honored to be on this panel with Kevin and Josh and Andy as well. We've been talking for years now, like you said, of where are we at in the cycle, right? When is this going to happen? Are we getting to the top? And I think the market has certainly revealed its timing now. I don't think any of us anticipated this cause of the timing for the market revealing itself, but we're in an interesting spot where we're not yet in a normal recessionary period, right? We're still dealing with a very acute external crisis that will result in a recessionary period, and we can manage through that, right? The unknowns that we're facing right now are what is the depth that this current health crisis is going to cause to our asset class in the real estate? How do we get our arms around the health side of this that's really causing that? And what feels different about this crisis is that this wasn't a real estate driven event like the global financial crisis was in 08 or 9, right? Real estate as an asset class entered into this crisis in a much healthier position. When you look at leverage historically, you look at occupancy rates, you look at rent growth, there were some very solid fundamentals in our asset class going into this crisis, but it's very quickly becoming a real estate issue. I just saw this morning, Fitch put out the news that 26% of all outstanding CMBS mortgages right now have asked for some kind of a suspension of payments. And compare that to the global financial crisis, it peaked at 9% of delinquencies and foreclosures. So we're looking at 9% during the global financial crisis of CMBS went to in delinquency or foreclosure. And already in this crisis, we have 26% of outstanding CMBS loans asking for some kind of a payment deferral. That's very quickly becoming a very real estate problem, right? The other change that we're seeing this time around than we saw in the global financial crisis, and Kevin, Josh, I'm curious to get your take on how this might have compared to the tech bubble back in early 2000s. But the amount and the speed that the Fed has acted and the government has acted with the stimulus package is just unparalleled in our history, right? So in the global financial crisis, it took almost a year, 18 months for some of these programs to be in effect. And, within the first month or two, we've had, I think, $6 trillion now pumped into the financial markets from the Fed and different stimulus programs. So the speed and the strength of the stimulus that's come out has been unprecedented. And I know we use that word a lot and we'll probably continue to use that word a lot. But there's a lot of firsts that we're seeing right now with this. And to me, it's a little bit unknown as to what the long-term impact of that stimulus will be on our asset class. Is it enough? Is this systemic issue going to emerge where real estate just enters or exits this in a very different position than it has in other recessionary environments? So I guess, with that, Kevin, Josh, curious to kind of get your thoughts on how this might look coming out of it compared to what we've seen in some of the other more, I guess, normal recessionary periods or the financial crisis time. Andy's muted there.
Okay.
I apologize. Josh, how would you follow up with that? You've been through previous recessions, and Adam brought up some interesting points, how this might relate to the Great Recession. What's your thoughts?
I spent some time kind of thinking about this, and there's a couple of comments. I view this recession, to a similar regard to the way we viewed the Great Recession, but there's a couple of things that are different. The first thing is, coming into this recession, the previous recession wasn't that long ago. It was 12 years ago. But then I think the last big recession was the 1987-88. And that was 20 years prior to the 2008 recession. So I think that a lot of the issues that people were dealing with in 2008 are much more in the front of people's minds than they were in 2008, looking back to 1988, right? And I think, so what does that mean? Well, a few different things. First of all, because that is fresher in people's minds, I think some people are better prepared. For instance, our firm, we had literally a recessionary playbook that we had kind of if X happens or Y happens, go to this play or go to that play. It's literally like a game plan. And we were much better prepared because we had just been through this 12 years earlier. Banks, I think, were also better prepared. They had, recent recollections of the 2008 era, and so their balance sheets were healthier, and they're willing to, I think, willing to be a little bit more proactive on helping borrowers. And the final thing is governments. Governments, as you mentioned, Adam, I mean, they're stepping in fast and really fast. And I remember back on March 14th, I said, all right, here it is. We're here. The NBA had just been canceled. It was that weekend. I remember thinking, I got my entire executive team together and we sat down and said, okay, let's pull up the playbook. And the very first thing we did that following Monday was the 16th, March 16th. I called up 26 of our banks and said, all right, here's what I want to do. And we went and started modifying loans immediately. And the banks, coincidentally, had just gotten direction from the Fed that said, hey, if you work with your borrowers, we won't penalize you. We won't make you have extra capital containments on your capital. And so the banks they were directed from the Feds to be much more active in helping. So to summarize, I don't know how this one's going to obviously end, but it seems like we're much better prepared for this recession than we were for the 2008. That's kind of my takeaway.
That's interesting, Josh. Would you think, Adam and Josh, with your comments there, you make a question of the depth and speed it came, but you add that we're better prepared. Do you think that will maybe alleviate and hasten the recovery a little bit quicker than we might see versus 2008 and 2009?
Kevin, Kevin, take that.
Yeah. Well, what I would add to that, Andy, is that most recessions, downturns, and while I'm the veteran of the group, I don't remember the Great Depression, Andy. So, but most recessions, the way out is when businesses and individuals begin to have confidence that things are going to get better, and confidence in the economy and new investments for business, consumer spending for consumers. When that fear of, am I going to lose my job sort of ebbs, and we begin to collectively spend our way out of it. This is different in that we're going to come out of this when we collectively feel safe from a health standpoint. Governments can say, open up, but if we don't feel safe and we stay home and keep, pull our horns in, nothing's going to happen in terms of the economy. So I keep coming back to the time when we're going to feel safe, whether it's going out to dinner and not thinking about it, going to a stadium. And that's really more around a vaccine than opening up plans. So I go back and forth, and my views on this certainly have evolved over the last month, but I go back and forth in terms of how long this is going to last. But when I really think about it, it seems like the vaccine is what will be the key to getting us more comfortable with this, so we don't feel like we're trying to limit our time around other people, because that's what most of economic activity is. You think about eating out, traveling, and that sort of thing, gathering for conventions and that sort of thing. The other thing that is more like, in terms of the result of this, they're all the same in terms of these downturns in the real estate market. You go into this period of a big bid-ask spread where the buyers want deep discounts and sellers are much more willing to hold unless they're really forced to do something. And as long as the banks are being generous, and the Fed is certainly egging them on in that direction, and with interest rates so low, I could see this period of little to no transaction activity going for a while until we start coming out of it and the smoke clears, if you will.
Kevin, if there's not a vaccine, I'm sure this is a question on many people's minds, especially with states trying to reopen. What is your take in terms of maybe the depth and timing that this recession may last versus maybe the last one?
Yeah, I think there'll be fits and starts, and I'm not a public health expert by any means, but I think there'll be fits and starts through this year and into next year until either the measures that we can take without a vaccine prove to be much more effective than people currently think, or we get a vaccine. So I would think by the middle of next year would be an optimistic view in terms of when things would really get cranked up. In terms of some gradual, recovery, I would think this fall, as things open up a little bit, it should get better. But the longer it stays slow, you're going to see more and more job losses in areas that you aren't obvious. They're not restaurant workers. They're not airlines. It's and you start hearing about more and more of those every day in terms of industries that are close to travel, like GE laying off a bunch of people around their engine aircraft production, and Boeing as well.
Oh, we appreciate that. Adam, anything to add? You gave us a couple stats of the depth of the crisis. Anything to kind of add on the topic?
I echo 100% what Kevin says. I think until we get our arms around some kind of control over this health crisis that's causing this, right? Again, this wasn't we can probably argue about what the fundamentals were that maybe led into this, what will come of this as a recessionary period. But really, this is a very acute external trigger that's causing this. And until we get some kind of clarity or certainty and confidence around how the health side of this, it's really driving all of this. I think there's still gonna be a lot of questions that are unanswered as to how it looks like coming out of it, what the trajectory is on the recovery. A lot of people are calling now for a Nike swoosh versus the V shape that I think we're calling for early. I think again, there's just a lot of unknowns still. We're still only a couple months into this, and without some certainty around the health side of it, I think we're going to be kind of waiting to see what happens for a while.
Well, we appreciate your answers, guys. I think the takeaways here is one, we'll have investor confidence, and one, everyone will start to feel safe with the recovery. With that, let's move into our second topic, which is properties. And I think perhaps this might be the hottest question in everybody's mind. Everyone's pondering, how is the real estate going to change? How will the current crisis change how we view, operate, and interact with it on a daily basis? Additionally, what are things that real estate owners should be doing to ensure the long-term viability of their properties? And perhaps what are things they should anticipate from a behavioral change? Josh, I would like to start with you. You've been a real estate operator here for 2 decades. What's occurring in your portfolio, and what are some changes we should expect to see?
Sure. So I'm going to tell you a couple stats here real quick. So across our office portfolio, which is the majority of what we own, we've collected for April, we collected 97.2% of our contracted rents. So that's most of our rents. And I think that's good. Part of me says people are still being productive working from home. And most of these people paid their rent before they got the PPP loans. So I thought that was interesting. Our retail portfolio, unfortunately, has not fared quite as well. Our portfolio only makes about 10% of our total portfolio, but just over 60.8% of our tenants have paid their contracted rents in retail. Most of our retail is strip retail anchored by Targets. Or shadow anchored, and so those are definitely getting beat up a little bit more. So a couple things from an operations, and we spent a lot of time thinking about this. The first thing that we're going to be doing moving forward is we're just going to be kind of planning for winters like this. I call these winters, where there's going to be times where it's just tough sledding, and so we're going to keep a little bit larger cash reserves on hand. If there's another pandemic that comes along, 2, 3, 4 years ago or from now, we'll just have a little bit extra cash. It just makes things a little bit easier to get through. In the short term, I'll tell you what we're thinking on doing in the short term and then long term. So the first thing, short term, we're reforecasting every property monthly. So every single month we sit down and go, okay, who's paying rent, who's not? We reforecast every single month. Second thing that we did is we're pausing on unnecessary CapEx. So things that maybe would be a nice to have, but not a necessity. We're just pausing on that until we get a little bit better clarity on the timing on this pandemic. Managing receivables, obviously very, very closely. We go through our receivables every single day as an entire team. So we're watching that really, really closely. The other thing that we're doing is we're really taking this time to freshen up our marketing materials. And so just making sure that we're doing, one thing that we did is every single property we own now is going on virtual tours. So we bought this, fancy 3D camera that goes out, and teams out there today actually filming every single property that we have that you can virtually tour. You can go and walk through any one of our buildings as if you were walking through, but do it on the internet. So that's how, like, what we're doing in the short term. Long term, a couple quick things here for you. The most important thing, in my opinion, is maintain occupancy. And I got a couple quotes. See, back in the 2009 era, I had a hedge fund manager send me a list from notes that Trammell Crow had put together in 1989. And this list was assembled by all the regional managers of Trammell Crow. And it was 113 pages of lessons learned. It was fascinating. And so I went through this back in 2013 after the session came out, and I started making my own notes from what I learned plus the Trammell Crow notes. And one of the best notes I got from Trammell Crow, there's two things I got that I loved. One, it says, make every deal at the best rate that you can in the recession. And the point was, he said, deals made in the early months of the downturn now look like great deals in retrospect. So you want to lock in deals as fast as you possibly can. The second thing that Trammell Crow on one of the notes said is if a building is leased, you can build it, you can finance it, you can sell it. Even if the yields, they say, are not quite to the pro formas, leased buildings present a variety of options. And so push hard to get high occupancy. And so that's one thing that we're doing really hard, is we're just cutting deals. Get the occupancy up, maintaining occupancy, doing the renewals. Maybe you're not quite hitting pro formas, but you're definitely maintaining occupancy. Second thing, of course, that we're doing is really just watching cash. We talk about this again, but just preserving capital. So that's what we're kind of doing from an operational standpoint. And I'll let the other guys take it from here, but I do have some theories and thoughts on both office and apartment buildings.
We'd love if you'd share them.
Well, okay, two quick things. So the one thing that I wonder is, and I don't have answers for this yet, but this is what I'll be watching very closely, is office. People, like I said, 97% of my office tenants have paid. And so does that mean that people can technically work okay from home now with Zoom and Teams and all that stuff? Is that going to mean a lesser demand for office space? Maybe. Or it could also mean that people want to be in their private offices and not be 30 people in one cube. And so there's a need for more office space. I don't know the answer to that yet, but it's interesting. The other thing that I heard yesterday that I thought was kind of interesting too is apartment owners, which are a good percentage of the millennials and younger people, they're starting to realize that being stuck at home in an apartment building for 30, 60, 90, 120 days is not all that attractive. And so could that mean that people might looking, especially in the Midwest, for instance, looking more at buying first-time homes? And then you start thinking, well, people can buy first-time homes and they can work from home. They got more space. Maybe there's going to be a lesser demand on apartments. Maybe a lesser demand on office. I don't know. It's what's going to be really interesting is how is this generation going to shift from apartments, which have been so strong, to maybe looking back out into the first-time home buyer arena again. That's one thing that I'm really curious to see how that plays out.
I think that's a good point, and we appreciate that Game of Thrones reference you made with winter is coming for everybody.
I think winter has come.
The winter is here.
Yeah.
Adam, would you like to kind of take us through? Obviously, you were more on the investor side, and you're looking to operators like Josh to ensure the long-term viability. What are things that you're hearing in trends, and what are maybe some things you're reaching out to your operators on a weekly basis saying, are we implementing things like Josh mentioned, such as virtual tours or having extra cash in hand?
Yeah, we've seen a little bit of everything, right? Starts with the lenders, seeing a lot of flexibility there. Starts with shoring up cash reserves. We've even seen a few managers do a capital call just to shore up balance sheets to make sure that they can, continue to operate. And it's like Josh said, the more you can get in front of it, the more you can get ahead of it. Deals and decisions that you make today are going to look probably pretty good, depending on how much further this can go down, right? So I agree with the speed there. Josh, you mentioned that you guys are doing virtual tours right now, right? I think the ability for our industry to shift to some of these new technology innovations that we're already seeing happen, I think that's going to accelerate. And our industry, again, has typically been a pretty slow one to uptake on new technology. But I think there is a really big opportunity for operators and managers to embrace some of these new technologies out there to transact digitally, right? To sign leases electronically, to show virtual tours, because business still needs to be done. It's not necessarily going to get done in person, and we have to figure out how to do that remote or digitally. I think one of the more interesting thought experiments that I don't know that we have answers for yet is what are those longer term behavioral changes that are going to come out of this experiment of shutting everything down for months, right? This is a first, and there's some very, very fundamental differences I think are going to come out of this, right? I mean, I look at my kids, 10 and 11 years old. How does this change their worldview coming out of this? That's a very impressionable age. We look back at 9/11, that was over 20 years ago, almost 20 years ago. And we're still complaining about TSA and airports, right? That was a lifetime change from a one-time event. And I don't even think we know what some of those changes are coming out of this behaviorally, right? To Josh's point, do we need 30% less office space? Do we need 40% more office space because now everyone's going back to private offices? Part of the interesting thing right now is we can forecast almost any scenario and paint a plausible path to get there. There's just no way to handicap which one's going to come true or not, right? I mean, there's a lot of potential outcomes and a lot of behavioral changes that will come out of this, but it's still so early that we just don't necessarily know what those changes are gonna stick after we kind of start things back up again and get back to some sense of a new normal.
Adam, would it be fair to say that no matter what, we'll see some technology improvements perhaps?
Gosh, I hope so. I sure hope so. Again, real estate's typically a very slow industry to adopt. I know Matterport, I think, just came out with a ability, and Josh, I don't know if that's what you guys are using, but you can now 3D scan an entire space from your phone, right? You don't have to have necessarily the super expensive equipment. So I think the ability to access these new technologies and for technology platforms to offer them at a attainable cost and expense so that we can actually start using them. I hope there's a lot of adoption of some of these more innovative technologies that are coming out in our industry for sure.
That's great. Kevin, you're actually in an interesting spot. You've gone from leading one of the largest real estate investment managers in the world to now you teach millennials in college. And so I think it's interesting to talk about how Adam thinks about his kids having an impression. Kevin, what's your thoughts? What type of things do you think might change for your students and, for your counterparts who are still leading Prudential?
Yeah, I mean, every one of us forced into using this technology, whether it's Zoom or Teams, has been transformational because it kind of works and people get used to it. There's still an element of the in-person contact that you can't replace, but you don't need it every day. And I think this is going to force, let's go back to the office discussion, which Josh started. I think this is going to force lots of corporate users into okay, we still want to have an office, but we don't need to have offices for everyone or cubes for everyone because so many people are out of the office. So this is going to tip it to where we're going to do some sort of hoteling setup in our offices and allow/encourage people to work from home a few days a week. And I think that will happen for sure. Now, there will be a situation where the bench seating is not going to look as attractive in terms of the health implications of that. So that will offset a little bit, but overall, I feel like the demand for office space, the need for office space is going to decrease coming out of this. Even forget about just a recession and, firms laying off people. I just think as a using community, we're going to use less office space going forward.
Okay.
And then, in terms of other property types, commenting on retail, first, Josh, people would kill for your 60% collections.
Yeah.
You're in a very good spot if you're collecting that much, if that continues. And when people I talk to, it's well below 50. But this is just another nail in a retail coffin that was already under construction. So it's just accelerating it, and you're going to see a lot more bankruptcies come out of this, I'm certain, especially if there comes a limit to the federal assistance and that drops off. I think that's when a lot of these companies will throw in the BK towel. So that's in terms of what's going to happen, that's the stuff that really comes to my crystal ball. Last one on apartments. There's been so much focus on making the apartment units smaller and providing community amenities, and you're part of this community. And in this environment, that's just a really bad combination. So whether that'll move apartments into larger units going forward, getting back to what Josh was talking about, and people needing more space in their units, too early to tell, but it could get interesting in terms of how apartments look going forward.
I appreciate that, guys. Just for time, we're going to move on, but Kevin, we're going to stick with you. And
Sure.
I think we appreciate kind of everything everyone brought up. Josh brought up winter coming and keeping cash and collecting the rents. And I think, Kevin, to reiterate what you, Adam, said, that the attendees should really latch on. It's going to look different coming out of this.
Mm-hmm.
Kevin, sticking with you here as we kind of move to our third topic, which is risk and underwriting. Obviously, as the elder statesman, you've been through a few of these. Each crisis is unique in how it impacts underwriting and how we evaluate risk. Kevin, if you wouldn't mind, maybe share your thoughts of how the current crisis will change even 10 years from now, how we're going to be underwriting and how we're going to look back, just like we did to 2008, and say, had we just known this, we would have underwrote that. So
Yeah.
Curious to hear your 2 cents.
Yeah, and in that sense, it is much like the Great Recession 10 years ago, coming out of that. So all that feels very fresh in my mind because having gone through that with a large portfolio, and all over the landscape, institutional equity investors, real estate equity investors are thinking about how they want to underwrite, and they're sort of re-looking at everything they do from. And most of it is going to be focused, I think, on how they're underwriting income. Vacancy, credit loss, very importantly, certainly in the short term. And then, what's going to happen with market rents, because there's not much visibility on that question yet. And then growth going forward. So I'm guessing that, institutional investors right now are thinking, okay, let me put a set of criteria together for sort of a V-shaped recession, and then a worse set of criteria for a more U-shaped recession. And they'll try to look at those and try to figure out which way the wind is blowing and which one they should lean towards. But I think that's what people are going to be doing. They're not going to really be that focused on, I want super high returns going forward. They know, if they're experienced, good investors, that that'll take care of itself. But they're really going to be focused on underwriting that income much more conservatively. Everyone knows that values in private real estate have come down. We just don't know how much yet. And that it'll take a while before those transactions sort of get fleshed out and we have some visibility. There's some things on the expense side that will probably be important. I worry about the position that a lot of states and counties are being put in now, and what impact that could have on their real estate taxes going forward. So I think that's something to really watch going forward. And then, landlords, and this goes longer term, Andy, are going to be much more focused on whether they themselves and whether their tenants have any protection against business interruption for pandemics going forward. None of us spent any time before 9/11 thinking about terrorism insurance or anything like that. It became a huge topic after that. And I think in the same way, this idea about pandemic coverage for business interruption will be a big thing going forward. And it'll take a while for that to get sorted out. But I think those are the kind of big underwriting changes that you'll see. And again, those will feed right into not a lot of transactions happening because the investors with money, dry powder, are going to be very, very careful in this environment. And most sellers are in good shape, at least for a few more months.
Is that a change, Kevin, from maybe the past 10 years, where maybe they're not forced to sell as they might have in 2008 and 9?
Yeah, even in 2008 and 9, there was a surprising level of patience among banks to extend loans rather than force a seller to dump the property at the low point of the market. And I think everybody's learned from that. And again, with the Fed being so encouraging of accommodation across the board, I think there'll be plenty of ways for owners to kick the can down the road, unless they are facing some sort of recapitalization trigger where they have to do something with a partner, or a fund's coming to the end of its life and they just can't, they don't have any flexibility from their investors. But I think you're going to see a lot of ability of investors to kick it down the road until times are at least clear and there's more certainty.
Okay, interesting. Adam, obviously you work with a pool of investors, and I think Kevin brings up great experience from managing institutional capital, but you obviously represent wealth managers, individuals, family offices. What are things in underwriting, maybe as an advisor to those people, that you're going to be looking for and making sure your investors see?
I think the biggest unknown and one of the biggest drivers of our industry is jobs, right? How do we forecast job growth coming out of this? Is it going to be more granularity into the specific industries of a geography? Is it going to be, this is a blip and we kind of go back to what historical job growth has been? Do we just apply a blanket reduction in that? So to me, and I'd be curious, I was putting my listening ears on for this question with both Kevin and Josh to try to see, how they're forecasting risk coming out of this. But I think, to me, job growth and understanding the reality of that picture coming out of this is going to be a really big impact. And I don't know if there's anything historically to really compare this to try to put a lens through which we look at job growth and how that will affect what we've seen historically. So I think that's the biggest thing that we're focused on from a risk perspective, is how do you underwrite that? I mean, obviously there's, no one's going to be underwriting extreme rent growth right now. I think everyone's going to be underwriting, far more vacancies. The extent to which is, just a personal preference, I think, on how bullish or bearish you are on the recovery. But I'd be curious, Kevin or Josh, how are you guys going to be looking at forecasting job growth coming out of this? Or is this, again, still too early?
Josh, would you like to add to that?
Well, I don't have a crystal ball on job growth yet. It's going to be an interesting one. Mm-hmm. Going back to the underwriting, I'm actually really, I shouldn't say excited, but I'm to a certain degree happy that there was a reset here, because things were just getting out of hand. One of my analysts, this literally happened the first week of March, came to me. They had this apartment deal they wanted us to do, and it was a ground-up construction apartment deal. And they brought it to me and presented the deal and land that we were about ready to put under contract. I said, all right, let's go through the economics one last time. We went through it, and they showed me a ground-up construction apartment deal at a 12% IRR. And I said, okay, a 12% IRR on an apartment deal, it's not a terrible deal if it's existing and it's a B-class building that's just performing, right? But I said, let's go through all your assumptions, and you show me why you think this makes sense. And long story short, we went through the assumptions, and we beat down the rents down to what I said, if recession comes, what does this look like? And we beat those rents down, 10, 20% even, just to say what it looks like. We knocked the occupancy down from 95% down to 85%, just to see what that looked like. And lo and behold, the deal didn't make sense. And I said, so why would we do this deal? And they said, well, this is what investors are willing to live with, is a 12% return. And I said, that doesn't make sense to me. We're not going to do this deal. It doesn't make sense to take that kind of risk to do a 12% return without, some greater upside. And so we obviously passed on the deal. And so now I'm excited because now you can actually go out and buy apartment buildings. You can buy performing apartment buildings that are, cash flowing. In fact, we're looking at one as Midlock, and, things producing a 16, 15, 16, 17% return, and it's in place. There's no risk. The tenants have been there for years. And that seems like that makes a lot more sense than doing these ground up deals at 12% returns. So that's the first thing. I'm glad there's going to be a reset, because capital was just getting kind of goofy in my mind. as far as the impact on underwriting, one other thing that I'm putting in place now is we're just going to do a pandemic scenario. We've always done scenario testing and stress testing, looking at reduced rates, reduced occupancy, et cetera. But now on every deal we're just going to do a pandemic. And I don't know what that looks like yet. I'll have an answer for everybody probably in 18 months, what a pandemic scenario looks like. But it's probably something to the effect of, hey, let's forecast only X% of our tenants, depending on the product type, pay rent. And what does that mean? And do we have adequate cash reserves in hand to basically see whether there's a storm there? And
it sounds like you're saying cash is king still.
it is, but you have to make sure that because you look at these really smart people. I look a lot to Bill Gates. He has his blog, Gates Notes, he calls it, and they're the largest funder of vaccines in the world. His foundation is, and so he spends a lot of time on these pandemics. And he says this is pandemic 1, he calls it. This is not. It's kind of like the First World War was the Great World War, and then all of a sudden became World War I. Then it became, then it was, of course, World War II. He's calling this pandemic 1. And so does that imply that there's more? Maybe, but we should underwrite a pandemic scenario in all of our deals moving forward. And that's what I intend to do with our projects.
Guys, I want to touch upon this and some of the questions, just so we know the audience is hearing us, has been asked, and we'll come back to that. But I want to move on to the next topic, and we're going to come back to everyone who's asking questions. So please keep filling those, and we'll make sure the panelists get some of these questions. But I think it's a good segue into our next topic, and I think it's steadily on everyone's mind, which is how do I make money in this scenario, and what type of opportunities should I be looking at? Adam, I want to go back to you just because you deal so heavily with investors, with your crowd. What are opportunities that they should be looking at in the coming 2, 5, even 10 years? And maybe walk us through where you see returns for different property types or different segments of returns.
Yeah, so I guess before that, I think what we're trying to get a handle on is where's the sentiment from the investor pool right now. So just last week, we launched our first we're doing a weekly sentiment survey. Results came in, investors are 3.5 times more bullish on commercial real estate than they are public equities right now. Again, the audience is somewhat self-selected to be naturally bent towards real estate, but I thought that was a good sign. 40% are actively looking for investments right now, and then another 16% plus or minus were wanting to invest, but they just don't know what the right deals are for them. So I think there's still a desire to invest in the asset class. There's still a fairly good appreciation for what real estate can do for a portfolio. And that's why we're all here, right? We love the asset class and the returns it can generate. We also asked about equity markets stabilization, and 70% disagreed that the markets will be stabilized in 2 months. So I think there's still a kind of a longer term assumption that there will be some continued uncertainty and fluctuations in the public equity markets for more than 2 months, and that was the same across managers as well. A few more numbers. It was a pretty even split on the real estate manager side between neutral, bearish, and bullish on private, on real estate investments right now. It was like 34, 35% in that range, 30% down on neutral. Over half of them were looking for acquisitions right now, and I think, Josh, to your point, right? I was a little bit surprised by the fact that over 50% were actively looking for acquisitions, right? I would have expected that to be more either pausing for right now or just focusing on kind of triage of the existing portfolio. But to me, those are good signs, right? That means that managers are still active. They're still trying to find deals. Investors are still bullish on the asset class, and they're still trying to make active investments. So that would tend to some ability to kind of continue making acquisitions from the manager side and continued activity, at least in our marketplace. As it relates to individual deals and returns, again, I think we're still way too early to know what that price impairment is on the private markets. A lot of people are looking to REITs as a proxy. I don't know how accurate that is, but I think we're still 3 to 4 months before we start to see some real price discovery in the private markets, because Josh is sitting on pretty solid rent collection right now, right? He's not going to be forced to make any moves, especially if the lenders are willing to work with him. And I don't know many lenders right now that they're not going to kick the can 90 days down the road, right? So to me, I think we're still 3 months out before we start getting to see some real price discovery and what those reset return expectations are. I don't know that that should be the focus going forward on the returns. I think it should be much more fundamentals of the deal. What is the impact coming out of this? What is that plan for recovery? And then the returns, as Kevin said, they'll take care of themselves, right? So long as you're looking at things from a risk appropriate perspective, the returns will be there. Are they going to be as juicy as they were coming out of the financial crisis? I don't know. I think we're still yet to see what the opportunity set is coming out of this. But to mirror Josh's point again, the market has revealed itself in terms of timing. It's somewhat good that there's a reset, because that means there's going to be more opportunities, and we haven't really been able to say that for 10, 11 years now. So there will be some good coming out of this from the financial perspective. I do still think that we're still a little bit too early to be able to really call what that's going to look like, though.
Adam, I just want to ask one follow-up question on that you pointed out that your user base, your crowd per se, is looking at public equities maybe not as the most attractive investment opportunities. That's really been echoed from the Wall Street Journal on down. Do you think it's an appropriate moment, given that the equity markets have largely recovered in spite of everything, that it might be time to keep some cash on the line for good real estate investment opportunities that may come the next month, 3 months, year, et cetera?
Yes, especially because I have no idea, and I don't think anybody really knows why the equity markets have recovered. Right? I think there's a lot of concern and questions about why is it back to where it's at right now? So it's just, who knows, right? And I think that's the thing that underpins this all, is the uncertainty. So yes, I think cash is always king. Having the ability to take advantage of opportunities. I think we're still, again, a little ways out before we see a lot of those deeper value opportunities in the real estate space, but flexibility and options are always good to have, for sure.
I want to go to a couple other panelists here. Kevin, you've obviously been through this a number of times, investing capital for many institutional investors. What is your take, and where would you be looking? I mean, you've managed many billions. If you had that portfolio at your discretion today, where would you be looking for opportunities?
Well, it's the most important thing. Exactly where the opportunities will be is a little hard to sort of figure at this point, this early point. But if you've got capital and you have discretion on that capital, and it's sitting there, you don't have to go raise it, you're in a really sweet spot. If you can be and just have some patience, see how this works out over the next several months. This is this part of the cycle is the best part, obviously, to invest in. So it's for those who are not burdened by huge problems with their existing portfolios and they have this capital that they can invest. It's actually a lot of fun. You do have to be patient and go probably through a lot of different potential deals, and try to talk some sellers into taking action. But it is the perfect time. Unfortunately, I think a lot of that powder will stay dry, just because people won't know exactly where the bottom is and be hesitant about pulling the trigger. But I think there could be some great opportunities. I would, very much look at existing deals with existing income and find situations where there has to be some quick discretionary capital brought to bear, and look for those situations. I think development is not going to pencil for quite a while. Even if construction costs come down as they should, just because the rents you're going to need will be a lot higher than the market will bear. So I think a lot of safe apartments will be a good play. I think warehouses will continue to be very expensive because the demand for those is not going to be impacted as much as for other property types. And office is kind of a wild card, and I would stay away from retail because who knows where the bottom is on that. So that's my quick scorecard.
Kevin, a couple people asked this on the Q&A already. Do you think we're going to see capital that maybe was earmarked for hotels or retail? Do you think it's going to go towards industrial, apartments, office? And I guess to piggyback off that, do you expect, will returns go down and maybe cap rates compress because more capital is chasing those quality opportunities?
Yeah, I don't think, I mean, you're going to see that reallocation. If there was capital allocated to hotels and retail, which would be a little bit mysterious to me, even before this started. But if there was, people are not going to be investing in those sectors anytime soon, unless you're looking at a retail deal where you are paying not just land value, but less than land value for a retail center. I don't think investors are going to be aggressive. In terms of cap rates, I don't think you're going to see cap rates go up a lot. I think people are just going to focus much more on what income is being capitalized, and that's where they're going to focus their underwriting attention. But I don't think cap rates are going to change a lot. They probably have gone up a bit based on today's in-place income, but over the next year, I don't see those changing a lot.
Before we transition to Q&A, Josh, you mentioned right before we started the topic that you're looking at opportunities here. You're obviously doing asset management. What type of opportunities are you looking for to take advantage of the situation?
Yeah, the one thing that we're looking at right now is apartments. There's an apartment project that we're looking at in Kansas, Overton, Kansas, and it's interesting because it's 166 unit, Class B, almost townhome style apartments. They're bigger units. And it's existing. They collected 99.x% of their rent for April, and it's a little bit older demographic. And the thing, it's just cash flows. The thing I like about that asset is that there's already existing debt that we're assuming, and it's amortizing quicker because we're coming into that assumption into a later date in that debt period. So that's something that we're definitely looking at. One thing I wanted to point out to the group too that I thought would be kind of interesting for people to hear anecdotally is, I looked at all my projects, and every bank that I have that's traditional, regional, or community bank debt, every one of those that I've requested a loan modification on, just to kind of prepare, they've granted it. Every single one of them. Some went interest only, some went straight forbearance. One bank said, hey, we'll give you, first they said, we're not gonna do anything. Then I sent them my receivables as a retail project. They said, okay, we're gonna go 90 days forbearance, just no payments. And you will just add to the balloon. So you only have to pay us back over the course of the loan term. Just pay us back when you pay the loan off in X number of years. And then they came back and said, you know what? We think it's going to get worse. Here's another 90 days. So they gave me 6 months. I didn't even ask for it. They just said 6 months forbearance. And so I thought that was really interesting. So the banks are being really accommodating right now. Like really, really accommodating. Nobody said no to me. And then you look at the debt funds. I only have one debt fund deal, and they basically said, "Nah, we're good. We're good. You can figure it out on your own. And if you don't, that's fine. We own real estate too." And so debt funds, we only have one debt fund deal, and I'm okay not having a bunch of debt fund deals because they kind of like loan to own, right? Mm-hmm. And then CMBS, we have one CMBS deal, and they're not overly anxious to accommodate either. That gets into a whole different thing with special servicers and all of that. And so the banks, while the recourse is not great as a sponsor, they're way more accommodating. So in my opinion, if you can go and do bank debt, watch your recourse, it's probably your best option right now. And so what does that mean? Well, it basically means that anyone that has bank debt, there probably not going to be any opportunities on buying those assets, whether it's in a distressed sale situation or not, for a while. Banks are just being really forgiving. CMBS, that takes forever to work itself through. I mean, I bought a few CMBS debts over the last recession. It took, forever. And then debt funds, they're probably more loan to own. So you're probably not going to get a whole lot of opportunity to come out of those guys either. So I don't think you're going to see a lot of distressed stuff in 2020. I think that's 2021, maybe 2022 period. So
I was going to say real quick, Josh, I think, the debt funds in 2015, 16, a lot of those were started by former equity funds, right? Yeah. They weren't happy with the basis getting in last dollar at 100%. So they started a debt fund. And if we're into it for, 85, 90% loan to value of today, then, that's a good discount on that. So I think the alignment of motives is going to be really interesting to see how that all plays out here going forward for sure.
Yeah. Adam, actually, it's a good question. Do you think, as someone who advises investors, do you think investors are going to ask the question, who's your lender? And are you comfortable if something happens like Josh talked, a pandemic stress test? Is this the lender we want?
Yep.
Yeah, I think it's a very reasonable question, right? And a lot of the managers we're working with that's the first question on everybody's mind right now, right? Is how are you mitigating any impacts of this crisis in your business plan. Varying levels of answers, right? And I think that's going to be pretty big question on the front of everyone's mind going forward is, how does this look like coming out of the recovery? What are you doing to mitigate those operationally? Again, technology, like we talked about before, the capital stack. I think those are all fair questions right now.
We're going to move to Q&A, and just to remind everyone who's on the call, and thank you, we're still holding above 280 attendees. So we've got a lot of people who are on the line here. We're going to answer as many as we can over the next kind of 10, 15 minutes. And a lot of great questions have come in. I'm going to start with lending, though, because that's where the group's kind of gone here. Do you expect the CMBS market to not be active? And do you think once this kind of all resolves, do you expect lending criteria to go up, such as escrow accounts, taxes, insurance, etc.? Josh, maybe I'll start with you on the operator side.
Well, you shouldn't start with me. I don't have an answer on that one. Rafi knows all about CMBS as being a recovering CMBS lender. But I think it's what I'm seeing out there from the CMBS side. Like I said, we don't have much CMBS debt. A lot of these guys are just pausing. They're just not doing anything, and they're just kind of waiting to see what happens out there. But I honestly haven't corresponded with the CMBS lender. I closed one CMBS deal last year, and what I've heard from that lender is they're not issuing any kind of new loans right now, no term sheets, nothing. They're just they're playing defense, and they're just managing. They laid off a whole bunch of their originators, and now they're just going into asset management mode. So a couple of CMBS shops I do have relationships with, both of them did pretty significant layoffs in April. So I don't think it's going to be a real hot area for a while.
No, Andy, I would think that the CMBS shops are be paralyzed for a while until the CMBS trading in CMBS bonds sort of normalizes a bit and people understand what the Fed is willing and not willing to do as it relates to the CMBS market, because that's how they price their debt ultimately is off of where those bonds are trading. So this sort of volatility is not good for them to try to line up a pool of loans.
Kevin, I want to stay with you here. There's one question, and someone brought up specifically that they're a New York native. I know you're out in New Jersey, where Prudential's been headquartered, talking about how New York's lost a sizable amount of jobs. Everything's becoming more efficient. Do you see the job market moving forward as it pertains to real estate being a factor, and how long might we have a prolonged unemployment job market?
Yeah, I mean, as it relates to New York specifically, obviously that's turned into not only the hotspot for the United States, but also for the world, unfortunately. And all the things that attract people and have attracted people to New York as it's had its renaissance work against New York in this sort of environment. Public transportation, just bringing people together. That's what that phenomenon is, the enemy of what's going on right now. So I would imagine that there will be some longer term job impacts in New York as it relates to less of a demand for office space, maybe some sort of ebbing of people wanting to live in New York. Maybe it speeds up the phenomenon of millennials saying, you know what, I think it's time. Let's pack off to the suburbs. We're having kids now anyway, so let's just get at it and have the yard and the school system and all that, where they may have been sort of putting that off. And this may be the thing that sort of spurs that on. The suburbs are due for a rebound, and I think this will probably speed that along.
The great suburban migration. You heard it here first.
Yeah.
Kevin, a follow-up question someone submitted. They asked about gateway cities or secondary markets. Just given what you mentioned with New York and your experience, maybe if you wouldn't mind, other panelists, feel free to join in here. What can you comment on, if they're looking for the next 5 to 10 years, do you think there's going to be a boom in secondary or suburban markets versus gateway cities?
Yeah, I mean, sort of going off what I was talking about New York, I think urban areas are going to be challenged to have the same level of just super demand for that kind of lifestyle going forward. And part of it has been sort of driven by a huge millennial population in that renter sort of early adulthood demographic. And that was bound to change anyway. And I just think this will sort of spur it on. But I don't think it's any part of the country necessarily will benefit. I just think it's going to be urban areas are going to be challenged to hold on to the growth that they've had and could see some near-term out-migration because of this.
Adam, looking to you here, I'm going to combine a few questions that have been submitted, especially with your platform. Someone said they commented they really love our perspective on giving different information such as apartments, industrial. When you're prioritizing deals on your platform, what's your take on hotel properties, student housing, two properties that were not mentioned? And then how would that impact how you would maybe view industrial or apartments or office as other asset classes that might be a little more desirable?
Yeah, I guess before I answer that, just to kind of piggyback on what Kevin was just talking about, to me, the driver of this urban exodus is going to be technology, right? If I can work from home and I don't have to commute an hour each way to get to my job, seems pretty attractive. So I think we will see more of that happen. And then again, who knows what the impact is? Is it larger apartments? Is it, was it due for home ownership? As it relates to hospitality, we put a freeze on all hospitality approvals for managers. And again, our focus is on the manager, not necessarily starting with a deal. So that was early last month. We put a freeze on all approvals for hospitality deals. Just because, again, there's so many unknowns in that industry right now of what that recovery looks like, especially on the health side, right? If we see some standardization amongst the industry of new cleaning protocols, and we can get some consistency and confidence in what steps are being taken in those projects, maybe some confidence will come back. But I think that's a pretty big unknown right now. As it relates to other asset classes, I mean, look, I don't think the demand for industrial is going anywhere. I think there might be some interesting shifts in the fabric of what multifamily opportunities are, but I don't think this fundamental undersupply in multifamily and single family rentals as an asset class, I don't think this changes any of those fundamentals. I think we're still, very underbuilt, certainly on the single family side. Who knows what this does for homeownership, right? In the millennials, this is two pretty big market events pretty close together, like Josh said, right? I mean, this is the global financial crisis, and now this, right in that time that people are, trying to buy those first homes. That's a pretty big hit for a lot of folks out there. So who knows what that does to home ownership rates? I think, again, it's just still so early in what this looks like that it's hard to forecast right now where those opportunities are going to be. But looking at the bigger fundamental drivers, right? I still think multifamily feels like a pretty safe spot. Industrial is going to be hard to go wrong. Retail, again, another nail in the kind of already being built coffin. So we'll see what that looks like. Actually, before I end there, I forget where I read it the other day, but someone was theorizing that retail, because travel is going to be so limited, because people aren't going on vacations, they're not traveling as much, maybe that money will go back into retail, right? Maybe they'll have more discretionary spending to allocate that towards retail purchases. I don't know if that'll happen or how big of an impact that could be, but those are the kinds of things that are those kind of second and third order impacts that we just have no idea how those are going to play out right now. And no way to really forecast the certainty of these different hypotheses.
Yep. Guys, we're going to wrap up with just a few questions here. And for everyone who answered questions, we'll do our best to submit them to the panelists and get answers perhaps after this call ends. But Josh, someone asked a good question. He was given your experience both with development and ownership. He mentioned that he worked with a general contractor who's seen pricing pull back 10 to 14% for construction costs. Given that pricing pullback, perhaps in the input costs for development, do you foresee more development coming online? And if so, is development the place to be versus maybe other opportunities in existing buildings?
Well, a couple of comments on construction cost. So I have an ownership in a residential home builder here in town. And on the residential construction cost side, what we're seeing is that there hasn't been a whole bunch of pullback or reduction in residential construction pricing, especially for the lower price bracket homes, kind of the first-time homebuyer homes, which I thought was interesting because it's completely different than what I'm seeing on the commercial side. And so on the commercial side, I'm seeing a pretty significant pullback. A perfect example is on one of my projects. We're having some sprinkler work done, and the project required about $300,000 in sprinkler work. And in April, I went back to him and said, I'm not going to do this work right now. And he said, okay, I'll reduce my cost from 300,000 down to 180. And I said, I'll think about it. I called him back a few days later and said, I'm not going to do that. I'm not going to do that work right now. And so then he came back to me and said, listen, I'm just trying to keep my guys busy right now. I don't want to lose them. How would I do it for my cost? $80,000. And so,
Wow.
massive reduction, right? But that's how frothy things were getting. Like, things were just out of control on certain things. And so I don't know if we're going to see a bunch of new development, but you're going to maybe see things that were getting tight and not being able to work, maybe start to work again. And I'm really looking forward to hopefully some of that actually kicking in so I can actually get some TIs built, tenant improvements built at a cheaper cost, and maybe cut deals that I would have been a little bit below my pro forma from an underwriting standpoint, but maybe still pencil out almost close to the same because costs are down that much too. So like I said, I guess in summary, the residential side, I'm really not seeing, especially in the single family home, I'm not seeing much of a reduction there at all yet. Although I am seeing it on the commercial side.
We're going to ask one more question and wrap up with a final word. Kevin, just given you're the elder statesman here, I'd like to have you answer the last question. Someone submitted that there's a very real possibility for a second wave in the fall and winter, such as the traditional flu. Given that we may see COVID-19 or the coronavirus again, how do you think it impacts the economy and the recovery? And then how long do you think it takes for the recovery to occur?
That's, I think, maybe an underappreciated, and getting back to the stock market valuation, an underappreciated real possibility when you listen to the public health experts. So I do worry about that, just as it relates to the economy, not specific to real estate, other than that could put a big put the brakes on in terms of coming out of this and job growth, and that is going to obviously impact the real estate. So it sort of gets me back to what I said near the beginning of the program, which was focusing on timing of the vaccine. And as that news of a vaccine, and there have been some things coming quicker than I had expected, so I'll try to remain hopeful about that. But focusing on the vaccine as okay, now we know where we're gonna end this thing, whereas this wave 1, wave 2, wave 3 is just going to be a real damper on people having confidence to lead us out of this economic downturn. So
appreciate that. To wrap up here before we cut everyone loose, and thanks again for our attendees for sticking with us. We're going to finish up with a lightning round, which is some pre-submitted questions from one of the attendees. And so the way this works for our panelists is there'll just be an either or. You just pick an answer, keep it very simple. And then we'll start with Adam, then Kevin, then Josh. So first question, starting with Adam. 10-year treasury is really low right now, 1 year from today, so 2021 of May. Will it be higher or lower than 1%?
Oh, then 1% lower.
Interesting. Kevin?
lower.
Josh?
I go with the crowd, lower.
All right, you guys heard it here first, lower than 1%. For the next 10 years, starting with Adam again, S&P 500 or real estate investing?
Ooh, I mean, both.
Balanced approach.
Yeah, a balanced approach, yeah.
Kevin?
REITs.
Neither. And Josh?
Trying to narrow, I mean, stock market, buying REITs at what are they down 25%? Looks pretty good. So,
yeah. Well, I'm just a dumb real estate guy, so I'm going to go for it.
Last two for the lightning round here. And this was also asked on the panel for the Q&A. Lots of questions about what letter our recovery is, and we'll give you a few options here. Josh, we'll start with you. The letter V for the recovery, the letter U, the letter L, or made popular here, the Nike swoosh.
Nike swoosh.
Kevin?
You.
Adam?
I think preparing for an L and hoping for a swoosh.
Okay, we'll get those sneakers on. And then lastly, this was a fan favorite submitted by one of the attendees. To keep everyone healthy here outside of real estate, we're going to start with Kevin being the elder statements. You prefer to use Purell or soap and water to stay clean?
Wait, I didn't hear the first one.
To stay healthy in today's environment,
Yeah.
do you plan to use Purell or soap and water?
Soap and water, because as you pointed out now about 10 times on the old-fashioned elder statement, so just soap and water.
Adam?
Soap and water.
Josh?
Water.
There you go. You heard it here first. Wash your hands, buy real estate. We appreciate everyone joining, and stay safe. Thank you.
Thanks, everyone.
Everybody.